Hey everyone, and welcome to The Explainer. It's pretty amazing, right? With just a few taps on your phone, you can jump into a world that used to be, well, pretty much just for the super rich. Buying stocks, trading crypto, all that stuff. It feels so simple, so accessible. And the best part? It's supposed to be free. But is it really? Let's pull back the curtain together and find out what's really going on behind that shiny $0 price tag.
So yeah, that's the big question, isn't it? We're swimming in these super sleek, awesome-looking apps, and they're all screaming zero commissions and no fees. And honestly, it sounds like a total game changer for finance, like a real democratization of the markets. But, that old saying, if it sounds too good to be true, it probably is. Well, we're about to find out just how true that is when it comes to modern fintech.
All right, here's our game plan. First, we'll tackle that free trading promise and why it's so darn tempting. Then, we're going to jump in a time machine and see how fees used to work, the old school, obvious way. After that, it's all about the new guard and their hidden costs. We'll also dive into the unique world of crypto fees. And to wrap it all up, I'm going to give you a fee-finding toolkit so you can spot all this stuff for yourself.
Okay, first up, the free trading promise. Let's start with that lure itself. We are living through a massive shift in how investing works. For decades, if you wanted to buy a stock, you had to, get this, call a person, a broker, and they'd place the trade for you and of course charge a pretty hefty fee for their trouble. It was slow, it was expensive, and for most people it just felt completely out of reach. But then the internet, and more importantly the smartphone, came along and just completely changed the game.
And this really nails the new reality we're in. All this new tech meant companies could automate what brokers used to do by hand. And that, well, it crushed their operational costs. So in this super competitive market, what do? They pass those savings on to us, the consumer, pushing that visible upfront cost of making a trade all the way down to zero. And naturally, that's been a massive magnet for a whole new generation of investors.
And let's be real, that marketing is so powerful. But it should also make you ask some pretty simple questions, right? Like, if these are multi-billion-dollar companies and they're not charging us a direct fee to trade, how are they staying in business? How are they paying for all those employees, those huge marketing campaigns, and all the crazy tech that makes it all work? The money's got to come from somewhere. And that, my friends, is where this story gets really interesting.
All right, Section 2, the old guard. So to really get how subtle the new way of doing things is, we first have to understand the old way. Before this whole commission-free thing exploded, the costs of investing were, well, they were right there in black and white, no hiding. And there was a kind of psychology to that, You always knew exactly what you were paying, which probably made you think twice before hitting that buy button. It was a super clear, totally transparent transaction.
And what's so wild is just how clear these old costs were. You really only had two main models. First, you had your flat rate. So you'd pay something like $9.99 to buy a stock, and then another $9.99 to sell it. Didn't matter if you were trading $100 or $100,000. Same fee. The other way was per share. So maybe you'd pay a penny for every single share you traded. But the main thing here is that the fee was obvious. It was a line item on your statement. No mystery at all.
Okay, so now we get to the new guard, and this is where things get sneaky. See, these companies figured out that people hate obvious fees. Can't stand them. So they got rid of those visible commissions. But the cost? Oh, it didn't just disappear. It just moved. It went into hiding, deep inside the mechanics of the market itself, in something called the bid-ask spread.
So what the heck is that? Well, every single thing that gets traded, I'm talking a share of Apple, a barrel of oil, even Bitcoin, it actually has two prices at the exact same time. You've got the bid price, which is the most any buyer out there is willing to pay for it right now. And then you've got the ask price, which is the lowest price any seller is willing to take for it. And here's the key. The ask is always a little bit higher than the bid. That tiny little gap between them, that's the spread.
And honestly, the best way to wrap your head around this is to think about those currency exchange booths you see at the airport. It's the perfect analogy. The platform, or the company they partner with, acts just like that booth. They sell you foreign currency at one price, and they buy it back from you at a slightly lower price. They pocket the difference. So when you place a buy order, they fill it at that higher ask price. And when someone else places a sell order, they fill it at the lower bid price. The platform pockets the difference. Now that difference might just be a tiny fraction of a penny per share, but you multiply that by millions of users making billions of trades, and suddenly it's a financial juggernaut.
So when you look at it this way, it becomes super clear. Zero fee absolutely does not mean zero profit for the company. These new apps scream zero, but they're making their money on that spread. or by nudging you to upgrade to a paid subscription for extra features. Compare that to a more traditional professional exchange. They might have what they call maker or taker fees, say 0.1% of your trade. It's not free, no, but it is transparent. With the new apps, the cost isn't gone. It's just been cleverly moved from an obvious line item into the plumbing of the trade itself.
Okay, ready to go deeper down the rabbit hole? Because this all gets even more complex when we jump into the world of crypto and decentralized finance, or DeFi. See, in this space, everything is built on public blockchains. There's no single company in charge. And because of that, a totally new kind of fee enters the picture, one that has nothing to do with the spread. This is a fee you're not paying to a company, you're paying it to the network itself.
So on a blockchain like Ethereum, pretty much every single thing you do requires computer power. When you send some crypto or make a trade, this huge global network of computers has to verify your transaction and lock it into the public record forever. Gas is just the name for the fee you pay to get those computers, they're called validators, to actually process your request. And here's the kicker. If you don't pay enough gas, your transaction just gets ignored. Poof, it won't go through.
Here's another great analogy for you. Think of the blockchain as a digital highway. Every transaction is a car that's trying to drive down that highway. The gas fee, that's the toll. Now what happens during rush hour? The highway gets totally congested. It's the same on the blockchain. When tons of people are all trying to make transactions at once, you get a traffic jam. And if you want to get into the express lane and get your transaction processed fast, you have to be willing to pay a much higher toll. And that means the cost can just swing wildly from 1 minute to the next.
And this chart right here really drives home what I call the crypto fee paradox. You look at a centralized exchange, a CX, and the fee is pretty simple and visible, maybe around 0.4%. Then you look at a decentralized exchange, or DEX, and the base fee might only be 0.1%. You'd think, wow, that's way cheaper. But you forgot to add the gas fee. During quiet times on the network, it might be no big deal. But during that rush hour we talked about, that gas fee can absolutely skyrocket. I'm talking 10%, sometimes even more, of your total trade value. All of a sudden, that cheaper DEX becomes insanely expensive.
So, okay, we've gone through all these different kind of sneaky costs. So how do you actually figure out what you're paying? Look, the goal here isn't to somehow avoid fees entirely. That's pretty much impossible. The real goal is to shift your mindset, to go from being a passive user to an active, savvy investor who knows exactly where to look and what questions to ask before you hit that buy button.
So let's make this super practical. Here is your 4-step toolkit for spotting these fees out in the wild. Step 1. Identify the obvious fee model. Is there a flat commission, a percentage, a monthly subscription? Get that clear first. Step 2. Always look past the free headline and just assume there's a spread. Step 3. Actively check that spread. This is a pro tip. Open up 2 different apps at the exact same time and look at the bid and ask prices for the same stock or crypto. You might be shocked at the difference. And finally, step 4. If you're diving into DeFi, always check a gas tracker website before you make a move on a DEX. That'll tell you what the current toll is on that digital highway. So look, the bottom line is this. The financial world is more open to everyone than it has ever been, and that is a fantastic thing. But you have to remember that free is a marketing term. It is not a business model. By understanding the difference between those obvious commissions, the hidden spreads, and those crazy variable network costs, you can walk through this new landscape with your eyes wide open. So the next time a platform promises you something for free, what are you going to look for? Now you know. The power is truly in your hands.